Welcome to this deep dive. Today we're tearing into Simulations Plus Inc., ticker SLP, right after their first quarter fiscal 2026 results dropped. That was after the bell on Thursday, January 8th.
Right, and for anyone tracking model-informed drug development, SLP is just a critical name. They build the software, the services, basically the digital foundation that biopharma uses to predict how a drug will work.
And this quarter was, well, a perfect study in what you'd call financial cross-currents.
That's a great way to put it. I mean, going into the print, the market was already a bit cautious, maybe a market perform kind of tone.
But the results themselves just immediately created this huge debate. Do you focus on the near-term earnings power, which, spoiler, was not good, or do you buy into the long-term strategic story they're telling?
And the market, at least initially, made its choice very, very clear.
Okay, so let's hit the top-line numbers first, starting with the part that was surprisingly okay.
Surprisingly okay is right. Revenue came in at $18.4 million. Now, consensus was somewhere in the $18.0 to $18.3 million range, so they actually beat that slightly.
But, and this is a big bin, but that's still down 3% from last year.
Exactly. So revenue basically held the line. The real shocker, the number that caused all the pain, was on the bottom line. Adjusted EPS came in at just 13 cents.
Just 13 cents.
Yeah.
And the street was looking for what, 19, 20 cents?
19 to 20 cents, yeah. So at 13 cents, I mean, that's a miss of around 32%. A colossal miss.
And the market's reaction was instant.
Oh, completely. The stock fell nearly 5% in after-hours trading. That tells you everything you need to know. The market prioritized that EPS miss way over the stable revenue number.
Which is fascinating because management came out and basically said, you know, the $18.4 million in revenue and the $1.13 in EPS, that was in line with our internal expectations.
Which is their way of telling Wall Street, look, we knew this quarter would be messy. We're in the middle of a pivot, and this is what it looks like.
So that pivot is really the whole story here. Let's dig into that because the mix of where that revenue came from, it completely flipped.
It really did. This is the core financial story you need to understand. Let's start with their historical backbone, software.
Right, the high margin, sticky stuff. Software revenue was $8.9 million. That's down 17% year over year.
And that drop means that for the first time in a while, software is now only 48% of their total revenue. It's no longer the majority.
Because the services side of the business just surged.
It absolutely did. Services revenue hit $9.5 million, which is up 16% year over year. So not only did it grow, it actually eclipsed software. It's now 52% of the business.
So this really underlines that shift toward more hands-on, high-touch development and commercialization work.
Exactly. But that brings up the big question, doesn't it? Services usually have lower margins than software licenses. So how did that affect profitability?
And the signals here were really mixed, which is where it gets a little tricky to analyze.
It does. Let's start with the good news, which was on the cost side. Gross margin actually expanded to 59%. That's a 500 basis point improvement from 54% a year ago.
A 500 basis point jump.
It was mostly driven by better cost management in services. The services gross margin itself jumped from 26% all the way up to 36%. So they're getting way more efficient at delivering on those contracts.
Okay, so they're delivering services more efficiently. But despite that, adjusted EBITDA still went down. It landed at $3.5 million for a 19% margin. That's down from 24% last year.
Right. And that's what really explains the pressure on EPS. The efficiency gains at the gross margin level were eaten up somewhere else.
So where did that pressure come from?
It's coming from higher operating expenses, SG&A, and critically a big investment in R&D, which we'll get to. But first, we have to drill down into that software decline because that's the market's biggest worry right now.
And within software, you have to split it into two different buckets, really.
You absolutely do. The core development products, we're talking GastroPlus, the Monolix suite, they still made up 81% of the software revenue. These are the mission-critical tools.
For anyone not deep in the weeds here, GastroPlus is what's known as a PBPK model. It's essentially a digital human that predicts how a drug gets absorbed and moves through the body.
It's a foundational tool. Regulators expect to see this kind of modeling, so demand there is relatively stable.
But the other bucket, their clinical operations software, that's where the damage was.
Oh, it was a bloodbath. The proficiency training platform saw an 82% decrease year over year, an 82% drop.
Wow. What does a drop like that tell you? Is it company specific or something bigger?
It's a huge macro red flag. Proficiency is used for clinical trial training, It's one of those budgets that gets frozen first when biopharma tightens its belt. Management said it was a tough comp to last year, for sure, but they also pointed directly to industry-wide slowdowns in clinical trial startups.
So it's more discretionary spending. They also mentioned that some big perpetual license deals for their QSP models didn't repeat from last year, which made the comparison tough.
Right, the quantitative systems pharmacology models, these are the really complex ones. They did stress that interest there remains super high, though.
Okay, let's flip back to the good news then, the services strength. This wasn't just random growth, was it?
No, it was very concentrated. The real engine was their commercialization services, specifically a business called Medcom. It grew 42% in the quarter.
Medcom, that's medical communications, right?
Right.
Helping companies with their data and publications.
Exactly. And that strength is building a solid foundation. The total services backlog grew 18% to $20.4 million. That's future revenue already in the bag.
There was one little flag there, though. The renewal rate ticked down to 88%. I thought they're usually above 90%.
They are, historically. Management said some deals just slipped from the quarter into December, and that ongoing client M&A is causing some delays, but it's something to watch.
Okay, so management is spinning this shift to services as a strategic positive. But isn't this just putting a good face on a drop in their core high-margin business?
That is the bear case, 100%. And it leads to the next question. How do you justify running R&D at 16% of revenue in a quarter where your profit got hammered?
And what's their answer to that?
Their core argument is that this is all part of a plan. They have this leading indicator thesis.
A leading indicator, meaning what?
They argue that when a client's budget opens up, the first thing they approve is a big, complex services project like building a custom QSP model. It's faster and easier than hiring a bunch of new full-time modelers.
So these service contracts are a Trojan horse, in a way. They precede a bigger software sale down the line.
That's the idea. SLT's people get embedded in the client's workflow. They build the models for them using SLP's tools. That creates incredible stickiness and makes renewing the software licenses a no-brainer later on.
So they're trading today's software margin for tomorrow's platform entrenchment.
Precisely, and that's why they're spending so much. The CEO said they're transforming from a collection of pioneering modeling tools into a fully integrated ecosystem.
Moving from selling individual apps to selling a whole unified platform.
You got it. And that requires a ton of R&D. They're literally pulling people from billable services work and putting them onto product development. That's why they're guiding for full-year R&D to be high, around 15% to 17% of revenue.
Okay, so this brings us to the most bullish counterpoint to that weak Q1. They reaffirmed their full-year guidance.
This is the part that is just. It's astonishingly aggressive. After missing Q1 EPS by over 30%, they didn't budge on the full year.
They're still calling for total revenue of $79 to $82 million, and crucially, adjusted EPS of $1.03 to $1.10.
Which, to get there, implies that the software mix has to snap back and snap back hard. They're guiding for software to be 57% to 62% of the full year mix. That requires a massive acceleration in the next 3 quarters.
They did at least guide for a sequential step up. They're looking for Q2 revenue around $21 to $22 million, which is up nicely from Q1's $18.4 million.
And they think the macro environment is going to help them get there. They're seeing biotech funding improve, pricing agreements stabilize, and, maybe most importantly, really supportive signals from the FDA.
Let's talk about that FDA part. What are these signals?
It's all around what are called NAM's non-animal methods. The FDA is releasing more and more guidance that validates using computer modeling or in-silico methods.
So the regulator's essentially saying, yes, please use these models to answer questions instead of running as many animal trials.
Exactly. It's a massive tailwind. It makes tools like GastroPlus a necessity, not just a nice to have.
Okay, this is all building to something. There's a big catalyst coming up, isn't there?
There is. This is the inflection point for the story. They have a virtual investor day scheduled for January 21st, 2026. And the whole point of it is to detail their new product vision and AI solutions.
Ah, AI. Of course.
Of course. But it's not just talk. They mentioned on the call that they've already integrated some initial AI features into GastroPlus, and clients liked it so much it allowed them to be a bit more aggressive on renewal pricing.
So the investor day is where they have to prove that all this spending on an integrated ecosystem is actually going to make them more money.
It's the moment of truth. They have to show the monetization plan.
Let's just put this all in context for a second. The stock's been an underperformer, right?
A significant one. It's down about 36% over the past year, while the S&P 500 is up almost 17%. The skepticism is already priced in.
The market is clearly in show-me mode. They're not buying the strategic thesis just on faith, especially after that Q1 print.
Not at all. The street is questioning if they can really hit that 26% to 30% full-year EBITDA margin they guided to.
So for you, tracking this story, what are the two things you absolutely need to watch?
Number one, you need to see hard evidence in the next earnings report that software bookings are rebounding. We need proof that the services as a leading indicator idea is actually true.
And without that, the full-year guidance just looks impossible.
Completely. And number two, more immediately, is that January 21st Investor Day. We need specifics. What's the AI roadmap? How are you charging for it? Is it a new tier, an add-on? And how does this integrated platform actually make a scientist's life easier?
Okay, let's move to our next segment. This is not financial advice. This is purely an analytical exercise, not a recommendation to buy or sell anything. But if we were to structure a trade around this setup...
It's a classic setup for a volatility play. You have the stock beaten down because of a backward-looking EPS miss, but you have a clear forward-looking catalyst just a couple of weeks away.
Short-term pessimism versus potential long-term optimism.
Exactly. So the setup is this. You want to structure a synthetic long position to play that Investor Day catalyst.
How would you do that?
I'd simultaneously sell some short-dated, out-of-the-money puts, maybe expiring the week of January 16th, right after the earnings dust settles. You're betting the initial shock wears off, and you collect that premium.
And then you use that premium to fund the upside bet.
You got it. Use that premium to go out and buy call options expiring, say, in mid-February after the Investor Day. And you target a strike price that gets you somewhere in the neighborhood of where the stock might trade if the market starts believing in that $1.10 full-year EPS number.
So you're basically using the market's short-sightedness on the Q1 miss to pay for a bet on the strategic narrative shift at the Investor Day.
That's the trade. It's a high-risk bet on the strength of their product roadmap and their ability to sell that vision. If they nail the presentation, the stock could re-rate very quickly.
Okay, let's wrap this up. To summarize our deep dive on Simulations Plus, a very mixed quarter. Revenue held in there thanks to a big surge in services.
But profitability missed by a mile, and the market punished them for it. Now, all eyes are on that January 21st Investor Day. They need to deliver the goods on their AI strategy and prove they can hit their very aggressive full-year guidance.
And here's a final provocative thought for you to chew on. Management expanded gross margins by 500 basis points, which is impressive operational discipline. Does that prove they know how to manage costs effectively through this transition?
Or does that massive 32% EPS miss prove that a services-led model is just inherently less profitable and way more volatile than what the market wants from a company that's supposed to be a software business?
That is the essential conflict they need to resolve.
It is, and until they do, the stock's going to trade on skepticism, not on promise.
Thank you for joining us for this deep dive into the numbers driving the market. We will be back soon with another detailed analysis.